Okay, great. Let's begin anyway. People can always review the recording afterwards. This session is gonna be a recap, and it's gonna be a bit shorter than the ones that I normally do. We're going to go straight to the charts. I'm just going to run you through the slideshow again, just in case some of you missed the previous one. This should be part three. I just forgot to change the opening slide. So welcome to you all. I can see Marie, Francois, Selena, just to mention a few. Nice attendance tonight. It's great to see you all in here. I hope that you had some luck on the markets. The last couple of weeks have been very, very volatile due to things with Greece settling down, and I hope that this strategy is pointing some people in the right direction and helping them to trade that little bit better. So just want to go through the disclaimer. All of the advice that I'm giving you here, it's interpretive. It's down to the way that you interpret the strategy. The rules of the strategy, they're not rigid. They can be changed. It doesn't have to be a 15-minute chart. It can be a 30-minute. It can be a 1 hour. It just depends on what type of trading strategy that you're actually employing in your trading. Me myself, I'm intra-week. I like to keep my trades open 3 to 4 days. Sometimes I do hold my trades for quite some time, especially with the pound, just to sort of hedge some of my other instruments. I have stocks and some gold, and I have different areas of investment. So the pound trading currency helps me to manage the risk in there, and I hope that you guys will learn how to do that as well. But as we say, slowly, and we'll take you into the Heiken Ashi strategy. I know there's some new people here, and I don't know if you reviewed the previous two webinars or the previous one webinar. Due to a technical fault, we didn't actually get the first one, so that was a bit of a pain. But Heiken Ashi, the goals are, again, to show you guys support and resistance. We're going to be using a blank chart to begin with the Heiken Ashi candles on there. The Heiken Ashi candles, basically Japanese means the average candle, so it adds up the high-low, open and close, and gives you a shading, a colored candle. It can be black and white, it can be red and green, it can be red and white as they are in the MT4 as standard. That's the ones I'm using, just so it doesn't confuse people, and it is what they are using also. So the goals are, working with price action. The amount of times that I've actually seen people's charts and they asking me, Mr. Martino, can you show me please how to trade the euro dollar? And I said to one particular person, I said, well, it would be great. I could show you how to use it, but I can't actually see the price action. He had something in the region of 12 indicators, about 8 moving averages on his chart, and I couldn't see anything. It's very important that you watch what the price is doing, and you always look left. That's one of my favorite sayings. Start from a very high time frame. A daily is normally the best for you guys. Weekly is for long-term investing. Unless you're going to be holding your currency or your commodities for 2 to 3 weeks or a month, then really a monthly chart is just for browsing through. Monthlies are great, but the charts all basically are giving the same information, just interpreting the number of candles that you see on the chart. So a monthly, they may be displaying 42 candles, which will be 42 months. If you switch to a daily, it will be 42 days. So you'd have a month of data. If you switch into a 4-hour, and so on and so on and so on. So it all shows the same thing, but it allows us to spot where we can enter, where the support and where the resistance are. So I want you guys to have a go at switching from traditional Japanese candles, which just give the open, high, low, and close, the price, and try and have a go with the Heiken Ashi. It's a great strategy. Most of my colleagues in the office are actually using my strategy. I'm sure that some of you have already talked to some of my colleagues, and they've showed you how to use them, how to hedge. I will be showing you how to perform hedging. Where hedging is simply on the same currency pair, opening a trade in the other direction of a different amount, of a different volume. So if we're a mini lot long on the euro dollar and the trade goes against us, then we could open up a sell on the euro dollar for a slightly higher volume. If the market moves X amount of pips, then we could close both positions either with a net profit or a small loss. So this webinars, me, Mr. Razak, and the guys who are also presenting the webinars, trying to give you a base, how to protect your investment. This type of trading carries a very high risk. So, you can lose all of your money, as I did in the very beginning, without just jumping straight into the market, really. I want to buy the euro and not looking at what the euro was doing. The euro fell by 1,000 pips, and my account's blown. It's gone. So this is what I don't want you guys to do. Now, in bold letters, identifying a tradable range. Tradable ranges are basically, if you are a scalper, a tradable range on a 15-minute chart will look very, very different from a tradable range on a 30-minute, on a 1 hour, on a 4 hour. It depends on what type of trader you are. We're all different. And this is what makes the market such a beautiful place to actually be investing in, is that if one person is making money in the market, then normally there's some poor devil on the other side of the trade that's losing money. So if you're $100 up, somebody is losing $100 somewhere. This is how the markets are working. This is what we call liquidity. Liquidity is the amount of trades that are open at one time in the market. And we all know, and we've been told, that the market is very liquid and roughly $4 trillion every day with leverage. So the $4 trillion, it's massive. It really is massive. This is why it's so nice, and you always get a trade in Forex. So this is just a slide for you to review from the recording, how the Heiken Ashi candles are formed. I don't want to take too long and go through this. I want to show the slides just very briefly, because I know that you guys have actually seen these slides before, so I want to go straight to a live chart, because I know that you guys, this is what you want. So I will just, if we don't have any technical failures, okay, that's not good. Let's see. Okay, let's try this slide. I always have a backup just in case that, okay. So determining the trend. This is a great picture. I just loved it because people are just in every direction. Don't know what to do, don't know how to find an entry, don't know how to exit my trade. Always holding on to my trades for too long. I'm sure you all know what I'm talking about. You open up a trade, you have a small loss in the beginning. You go to make a cup of coffee or you go out for a few hours, you come back and 3/4 of your account is involved in the trade. You're losing. Now, at some point, we have to learn how to either cut our losses or employ a hedging strategy. And I generally don't use stop loss. I use a hedging strategy, which I'm going to show you, not today, but I will be showing you in future. It's very, very good. It allows you to control loss. So this is going to be great for you. Determining primary direction. Is the trend going up? Is the trend going down? I'll switch to my live chart. Let's go to a daily and let's zoom out. This chart, we're too close to the market. We can't see anything. It's not helping me in any way to form an opinion on where the trend is going. So I'm going to go further out. I'm going to go even to a weekly. There we go. Now, I'm sure we can all assume which way the trend is going on this chart, and the Heiken Ashi, it's just a pure confirmation. I'll just take the bars off, because what I do sometimes is I have the Japanese candles in there as well. So what you need to do is when you add your indicator to your chart, you need to turn off the Japanese candlestick. So just either go to a bar chart or go to a line chart. just by changing this. So we'll use a bar chart because we don't see the Japanese candlesticks. And what a beautiful identification of trend on the euro. And this is thanks to Greece, you know, for weeks and weeks and weeks now, you know, all the way back to, you know, imagine just opening a trade here. How wonderful it would be if we were still in that trade at 137.43 and we were actually profiting 2,600 pips. It would be beautiful. Doesn't happen very often, but the Heiken Ashi, if you're a long-term trader and you actually employed the strategy and you actually got into a trade on the strategy, a short trade, the market goes over the trigger line, comes down through the red line, which is price, and we're looking to short it somewhere in the future. Something is going to happen. The market came back again. This is a false buy, where the markets are very close to the trigger line, to the 80 line. You know, we have to be a little bit cautious. We're not going to rush into things. But this would probably be the best entry. If we could get in around this point back there in 2014, which is crazy. We're holding a trade for a year. I've never heard anybody hold a trade for a year apart from long-term investors. Maybe you do. Maybe you open a trade. But me personally, I like to trade intra-week, which means I'm a Tuesday to Thursday trader. I don't trade Fridays and I don't trade Mondays because on Monday we have the weekend break and we have all of the volume coming back into the markets. The best time to trade on Monday is usually after the American market has opened. If you like to trade the Australian dollar and the New Zealand dollar, then you're going to be trading the market straight away from midnight. So it just depends on three things: what you're trading, type of trader you are, and you know, do you feel comfortable opening a trade on Monday? But determining the trend, we all know the trend is going down. Down here somewhere we have a little bit of a reversal. You know, it's nothing serious. The price has not even pulled back more than 20%. And what I mean by 20% is if any of us know Fibonacci, and I'm a big fan of Fibonacci, we can stick a Fibonacci retracement on right from the very top to the bottom, and I'm guaranteeing that this will be roughly 23% of a retrace. Now, it's a lot of pips because we're on a weekly. So if we look from bottom to the top of this retrace, we're talking 1,000 pips here. So, you know, when I say it's not much, on a weekly, it's a lot of pips. Most people don't, you know, I very rarely do I see 1,000 pips. I'm taking, on my trades, I'm a pivot trader. I use this strategy. I look for 50 to 100 pips, which is on the euro dollar, the daily range. Now, that we can determine what the daily range is by switching to a daily chart and putting the ATR on, which is this indicator that we have here at the bottom. It's a 14-period ATR, and it gives us a baseline. Now, what we can do is we can put our cursor onto this baseline, and it will tell us on the right-hand side, or it will give us a pop-up, and it will say 0.02283. What this means is just ignore the 3 at the end. It means that at this point on this chart, this particular instrument, the euro dollar, was moving 228 pips during this week. So in 1 week, it moved 228 pips. Now, if we look at it here, a little bit closer to where we are, 2015, 31st of May, we can see the market was moving 378 pips. So this gives me a range. It gives me a target. So if I'm looking to trade intra-week, normally looking at picking up either half of the weekly range or a little bit more. So on a daily, if I just flick you to a daily, we can see the ATR is very, very different. The chart's very, very different. The stochastic indicator, it's very, very different. If you're wondering what settings the stochastic is on, I change them and I do a 14.7 and 3. Some people do a 14.5 and 3. Some people do a 14.8 and 3. You know, it's whatever, you know, you want to use. But this one, 14.7 and 3 for you guys. We can see the ATR. If we just go to today, we can see that today the euro dollar moved today so far 116 pips. So it's that 100 pips. I like to aim for 50% of the daily range. So I'm looking for 50 pips sometime during the day. And I either get my pips early in the morning or I look to trade. Maybe there's a news event coming or the opening of the European market at 10 o'clock or 8 a.m. in England. Normally gives us a push higher or a push lower. We just have to identify it on price. We're looking at what the price is doing. So the stochastic indicator, it's just a way of identifying is the instrument overbought as here. I'll just outline it for you. I do have some drawing tools, I forgot. So, overbought here, oversold, and again overbought, looking for entries. Every time it goes to the extreme, I'm always looking to get in. Over down here, I will be maybe taking a look at this area because I know that there's support here. I know that there's support here. This is just rough. I'm sorry for my drawing. I'm not the best artist. The support levels, two very big ones on the daily. There's more as well. If we put, I want you guys to draw horizontals on your chart. I want you to put daily ranges. What I'll do, I'll just get rid of these. Let's stick on the chart some daily ranges. Okay, just get rid of my drawing tool. Okay, some nice daily ranges. So we're going to put a few support lines on. I'm going to do it very quickly. This is a short session today. Now we have support, and if you notice the pattern starts to form. When you start to do this, you'll notice that there's a pattern here. The market, it loves to follow patterns. It really does. And where a price has happened previously, this price, sometime in the future will happen again. And it's what we call always looking left. I just love that saying. Always keep looking left on the chart. So what I've done for you here is just put some support resistance lines on. And what we'll do is just type into your chart what's your favorite time frame of chart. I'm guessing it's going to be the 1 hour. El Marie, Francis, what sort of time frame do you like using? 1 hour chart, is it? Just type into it, yeah, 1 hour, 30 minutes, Francois, 1 hour, Francis. Yeah, I thought you guys would be 1 hour to 30 minutes. 15-minute chart for Aminu, Metaduzi, 30 minutes, Hans, 4 hours. So Hans is looking at the slightly longer investment. Sabello, the 1 hour, looking for intraday charts. I see that we have a nice assortment of time frames here. So this is going to be great for you guys. You can use it on any time frame. So what we'll do is we'll go through the time frames. So we'll go from the daily. Now we have these ranges on here. We flick it down to the 4 hour and we have daily ranges on the charts. So we know that they are daily because we just put them on. So on the 4 hour, they still carry significance on the 4 hour because I want you to use them in conjunction with Heiken Ashi, which is changing of color, first white candle to buy, in conjunction with the cross of the blue line up. If you want to use a stop loss, look at what the ATR is doing, 36 pips, and I always like to maybe either double that just to play on the safe side, or even better, just look where the next range is down. So we can see that the next range down, if I was going to enter on this candle here, so let me draw on the chart for you. If I was looking at entry here, I want to know where's the price been, and I can either put, if I'm going to use a stop loss, that is, stop loss will be, either double up your ATR or stick 20 to 30 pips on a 30 pip ATR, and you will be setting 70 pips away from the market. Now, you have to do one of two things here. When you're looking at putting stop losses in, allow the market to breathe. Very important, that you give the market room to breathe, so that you don't get a spiky candle. You can see here we have a spike of 120 pips on a 4-hour chart. If we set too close, we're going to be taken out, we're going to lose money. And the most frustrating thing with stop losses is we put our stop losses on there to protect our money, but you lose more money in the long run if you don't know where to set them. And I'm sure you're all saying that, wow, he's absolutely right. I'm sick and tired of putting a stop loss in here and getting taken out early. So always look left on the chart. You can either set your stop loss underneath here. So if we were to enter here, let's say we were to enter on a break above this range. So we could look left. Our stop loss, well, the bottom of the market is about 61 pips. So that kind of ties in to what my ATR is saying. ATR is telling me that it's 38 pips. So I'm going to put 30 pips on that and set 68 pips away from the market. So my stop loss is going to be 68 pips, which is here, which is very nice. So this is a way of you guys being able to set stop losses not too close to the market and allowing the market to breathe, because we can see here that the market spiked back to where it was here. So we need to allow it to breathe. Most important thing is as well, guys, is when the market moves up, don't leave the stop down here. You need to trail it manually, which is what I always do. And I use something called 3 to 5 bar trailing stop, manual trailing stop. So I'm going to count the bars as they're moving up. If the market goes sideways, such as this area here, if it's going sideways, I'm going to count all of these candles almost as a one candle. But because we're on a 4-hour, it's a high time frame. So we're looking at, just let me erase that. So we're looking entry here. So this candle didn't go anywhere. This candle really didn't go anywhere. This is really the first move up, 1, and then we went sideways. So all of this is 2. This is 3. Do I want to move my stop up so early? Well, if we look what happened here, I would have been taken out. If I'd have moved my stop up behind this candle, would have been taken out too early. Yeah, on Kvetsi says you're right. That's the challenge, setting the right stop loss. Yeah, absolutely right. And what I will do for you guys is in a future webinar of mine, I will show you how to not use a stop loss, how to trade, and how to manage risk by hedging, which is, it's what all of the professionals do. Why do you think Warren Buffett, is a billionaire? I don't know Warren Buffett ever setting a stop loss on any of his gold trades. I've never heard of it. And this is why he's successful in what he does, is because he has a strategy and he doesn't play into the market's hands. We're all, in a way, we're all slightly stupid for using a stop loss, but on the other hand, we can get caught out if we don't do the hedging correctly, or the market, there's a non-farm payrolls announcement and the market tricks us and moves too quickly and we can't hedge quick enough, then we can lose money. But this is the challenge. So, trailing the stop up, definitely I'm looking for sort of this kind of movement, and I'm looking for a 1, 2, 3 candle and bringing the stop up underneath here. Then the market again, it moves at 1, 2, 3, and then moving it up to here. So, I'm trying to enter here and I'm trying to get out somewhere around here. So I'm always trying to lock in profits, always. I generally, if I'm making 20, 30 pips, I'm not greedy. So I always either take my profit or I bring the stop loss up somewhere reasonable and that's determined by what the range is doing, what the price is doing. It's my own personal strategy, and you will develop your own, I guarantee it. So, I want to show you a couple more slides. I'm trying to get through this in an effective way. So I'm going to show you all of the slides fairly quickly because I want to go back to the chart, because I know this is what you guys need. You need to look at charts. You need to determine when to get out. This strategy is what I use and most of the pros are using in conjunction with hedging. So, you can use this, you can make money doing it, and you have all of the basics, which is great. I added a chart. This presentation, by the way, guys, I'm flicking through it fairly fast. I'm not going to read everything on here. It's all about determining trend. You can replay the recording back and pause it. This is why I'm just sort of flying through it. This is the chart which I wanted to show you. From a website today, I came across it. It's not one of my charts, but it does indicate exactly how the strategy works. So what we're waiting for is this actually has a 9-period exponential moving average and a 18-period exponential moving average. What we're doing is we're waiting for a cross, and I know Mr. Magda, I can see him there, and this is what he's been trying to have a chat with me about it. I'm sorry, Robert, for not getting back to you. Been extremely busy, but he loves to use the EMAs and wait for a cross. And now I've actually found a nice chart to illustrate how the cross works. So what we're waiting for is we're waiting for bearish candlesticks heading down, and we want them to touch both of the EMAs for an entry. So we're looking now for the first bullish candlestick after the price actually touches both of these moving averages. So we're entering here, entry for a long position. Okay, so we buy. Now what we're waiting for now is the price to track along the 9-period. We're not waiting for it to come back through, because once it comes back through them both, it's the end of the move. We're out. So you can use the yellow, the 18-period moving average, to use as a stop loss. So if you're unsure of how to use the ATR, and you're struggling, you're still getting stopped out, use the 18-period as a stop loss. If you want to be a bit more daring, then you can put something like a 12 or a 13-period that will put you somewhere in the middle of these two and will allow you to be tighter to the market, but not too tight. So let's say that we're bringing our stop up behind the market underneath the 18-period, and once the market comes back through both of the EMAs, and we actually have a cross, this is it. This is, we're either going to get out on the first Heiken Ashi red, or we're going to wait for the price to come back through both of these moving averages. It works because I've tried it. Not in every single market condition, but if you have a good entry and you trail your stop loss up, it doesn't matter if it works or not, because you're locking in profits. What most people do, most novices, new people to trading, is that they leave their stop losses where they entered. So they're allowing the market to go up and to come all the way back down to where they entered. So they lose all of their positive P&L, which is a shame, because what they were expecting the market to do was just to carry on going up, and it never does that. We know that. We have to have retracement. So these are the trading rules. Pause the video, take a look at them. I'm not going to go through every single one of them because I just did it with you on the chart. But pause the video, take a look at how to buy. We can see here, the top of the slide. Buying trading rules. Love it. Couldn't be any simpler. Selling trading rules. Read. Please read the slide. It's absolute gold in your hand. I know Leslie, she said to me, Andrew, I'm really struggling. She sent me a wonderful email. She said, I've been struggling for so long, felt like a headless chicken, which kind of made me laugh. She said, since you showed me your strategy, now I'm making money. Thank you so much for your help, which is wonderful, which is why I do this. You know, as well as now being the in charge of the dealing desk with CM Trading, which is wonderful because I can keep an eye on the platforms for you guys, make sure everything runs smoothly. I get to do these wonderful webinar presentations, which is fantastic for me. I just love to do it. I talked previously about how to scale in, scale out. I'll stay on the slide for 5 seconds, move to the next. And I talked about the 3 steps to entry on the previous webinar as well. How to achieve 75 to 80% strike rate on your trading. And the conclusions. You know, there are pros and cons to every strategy. It doesn't work every time. But I guarantee you, when I've showed you the hedging strategy, which will be very shortly, I'll keep this series going. If you guys have suggestions of what you want a webinar to be about, then you know you have my email address, which is on the first slide. It's martino@cmtrading.com. Please send along to me suggestions of what you want, and I'll be very happy to do a webinar for you. So switching back to the live chart, any questions so far? Okay, Francois, great. So, you know, please take a look at the presentation. I didn't want to make it too long, but what I do want to do is, are you guys okay with the whole idea of support and resistance, how to put these lines onto your chart? You know, there's a rule to this. You know, the market must have touched a minimum of 2 to 3 times in the same area. The more times it touch, the more relevant it is. If they touch 3 to 4 times on a daily, that's much more significant than it touching 3 to 4 times on an hourly. So the higher the time frame, the more significant the support resistance is. I know if you have a few EMAs on your chart, my favorite are the 200, 150, and 21. These are the ones which I swear by religiously. And if you add a 200 period moving average, which I'll try to do for you, so we'll make it a 200 exponential, put it on the chart, and if we go to a daily, the 200 period moving average is the moving average that all of the banks use, all of the large institutions, and you'll see why very shortly. The reason why is because the banks are looking to make the big bucks. They're looking to find the big moves. So every time the market comes into contact with the 200 period moving average, it goes crazy. As you can see here, you know, the strategy which I showed you, it does not work on a weekly in conjunction with this, unless you're getting in very early, which is back here. Then, you know, we have an entry. But, you know, if we're looking at this fall here, we can see the stochastic, it doesn't really give us anything. So, you know, it's like I said to you, it's interpretive, and I know for a fact none of you guys use a weekly. You're only looking at the weekly to identify the trend, and this is what I want you to do. So let's go to intraday. Let's look at 1 hour. Now, 1 hour trend, we can see straight away is if we put some moving averages on here. So I'll put you let me see. So let's have a 100 exponential. Let's make it green, whatever. It doesn't matter what color they are. And we'll do another one. Let's make it a 50. And let's make it purple. Okay. And we'll do a 21. Now these are the moving averages which I swear by. These are the ones which I use to trade with. I'll make this orange. And what I want to show you here is that even on a 1 hour, where these moving averages are crossing each other, we have a few. We have the purple crossing through the blue, which is the 50 coming up through the 100. We have entries in conjunction with stochastic. We can have entries. If we still don't know what we're doing and we're like, oh my God, I still don't get this, then we're just looking at colors. We're waiting for first red candle, first white candle, red to sell, white to buy, in conjunction with our stochastic. Always, 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 we need three things on a chart to give us an entry. So, this would be, let's see. We can go with an entry here because the market's been down to the 20. It's come up violently through the price. So the market fell. We have an entry point here. Now we're looking for an exit point. So the exit point would be the first red candle afterwards. So then we're out. So if we're entering from here to here, we made 57 pips. So once again, we're looking for another entry. Sometimes the charts are they don't play right with us. So this stochastic, to me, I don't like it because it's not really reaching both sides of the stochastic. So if we flip down to a 30, this to me looks a little bit better. Now, probably you guys, after looking at the last couple of webinars and studying this Heiken Ashi theory, would probably be using 30 minutes. This is what I think anyway. And entry points on our chart, long entry points. We'll do all of the long ones first. So blue up through red, this would be one. Blue up through red, this would be one. Blue up through red. Looking here again for an entry. These are long entries. Nice short entries. One. Yeah, market's a little bit undecided here. As I said to you, it doesn't always fit. This is why we have to have ranges. And the purple horizontal, we have a range from here to here. We can use a breakout strategy. Don't always think to yourself, oh my God, the stochastic is not showing me anything, I'm not going to enter. When you have a move like this, even if you're waiting for 3 or 4 candles, which would be a couple of hours, you can see the market's moving up. Why are you not placing a trade when the price is above all of the moving averages, and it's this distance? When the price is above these moving averages, we're looking at entering. You can see once the price moves back down and touches, then we have some kind of reversal happening. So tip for the day is don't always rely on the stochastic. It's an indicator. It's lagging. It's not the Bible. It's not showing us something special. It's just giving us help. All of these indicators are helping us to decide when to get in and when to get out. So as long as the market stays above, we're golden. Then we're looking for a short entry. Nice short entry here. First red candle. We're waiting for the first white candle. This is the first white candle. So we'll exit. Somebody asking me, Isaac's asking me to show the hedging strategy. I can't today as I'm a bit short on time, Isaac, but I promise you I will show you the hedging strategy. It's a little, I have to make some PowerPoint slides for you guys because I want it to be illustrative. I want you to fully understand it, or you're going to get yourself into trouble when you try to do it and it doesn't work for you. So I'm going to leave it there for today. As I said, a bit short for time. Any questions that you do have, send them along to me, martino@cmtrading.com. I will be more than happy to help any of you guys. I want you to be proficient traders. I want you to enjoy trading because I know that when you're losing money, it's very, very hard to get your head around it and get back into get back into things again. So we'll do a continuation of this. We'll try to do a 1 hour session again in a week or 2 weeks, and I will try to incorporate into that this hedging strategy for you. But it's quite difficult to grasp because we're using different volumes and different entry points. So I want it to be good, and I want it to be simple. So I just want to take on a few questions. I have maybe another 3 to 4 minutes. If you have any questions, stick it in there. I will try to answer them for you. I can do it on the live chat. Any questions about instruments? One of my favorite instruments is the DAX. Become very proficient at trading on DAX. There's a lot of money to be made, but it's quite expensive to trade as an instrument. A lot of margin required. So if there's no questions, guys, I'm going to. Would you use Bollinger Bands, El-Marie? Of course I would. The Bollinger Bands are basically a 20 period moving average with the upper and lower band being a percentage of the moving average. They're very, very good because they give us a channel, and we all know how Bollinger works. When price exits the upper Bollinger, we're waiting for it to return either to the central, which is the 20 period moving average. It's, as I said, I use the 21 on my chart. So one can combine a Bollinger in there. Absolutely. You should be sticking to things you know. Don't completely switch strategies. If you have a strategy that's semi-effective, then this Heiken Ashi, all you need to do is change the candles. It will work with Bollinger. And I can go through all of the indicators with you guys. If you guys are using fractals, if you're using I don't know, parabolic, I have a parabolic SAR on this chart. Yeah, Williams, yeah, alligators for sure. All of these instruments have definite uses, but it's as I said about the stochastic and indicators, they are lagging, and even the Williams, the alligator, it's not a 100% surefire. So let's get used to using this. I'm going to keep on hammering the information into you guys. It's a pleasure to try to help you. Try to review the recording, take a look at the slides, pause them. I'm sorry I didn't go through all of them again, but I don't want to make the webinar about the same thing over and over again. So we're going to be moving on, and we're going to be looking at placing some trades. This is a test account which I'm using, so I'm going to be looking at placing trades in here with you, showing you how to set stop losses, maybe doing a little bit of online scalping with you. We're going to spice things up, but I want to show you the trade management, money management, how to manage your risk, how to use stop losses. It's all going to be in the previous webinar. Aminu is on the website. Unfortunately, part one it didn't record on the software, but go to the website. It should be uploaded on there now. If not, I will send you a recording. Just email me, martino@cmtrading.com. I'll be very happy to help you. I'm going to shoot off now. I wish you all a very, very good night. Thank you for attending. It's always nice to have you in here, and we'll see you again. There'll be another fantastic webinar by my colleague next week, and I will do the one after, and we will do some hedging. So El-Marie, pleasure. Hans, Onkabetse, have a wonderful evening. Take care, and we'll see you soon.